It helps focus on the fundamentals behind the technicals. To take a look at metals with us this morning, Paul Nolte's here, Senior Wealth Advisor, Market Strategist at Murphy Silvis Wealth Management. Paul, always good to have you here on the Future Show. Let's begin with gold, this trend we're seeing to the upside and how we're flirting with a new all-time high, closing high today.
Yeah, it's true. You know, when you take a look at it, and we've talked a lot about that relationship between the gold, between gold prices and the dollar. Gold has yet to, it's very close, has yet to make all-time highs relative to the dollar. So that chart that you just showed, if you overlay the dollar on that, you'll see that we're back to not quite those all-time highs. I think what has shifted here in the narrative is really around the Fed and monetary policy. Monetary policy is very easy at this point. I think the Fed chairman, Jay Powell, has indicated we're going to allow the economy to run hot, both from an economic growth perspective as well as inflation. I think the comments that he made was, we're going to allow inflation to continue to be at this 3% level. We anticipate it's coming down, but we're more concerned about economic growth. And I think that's really given a risk-on attitude for a lot of asset classes. And gold is one of them. Certainly the markets, Bitcoin, even bonds have rallied here.
You know, Paul, talk to us a little bit about how, well, oftentimes we look to crude, copper, some of the more industrial type products to get that inflation gauge. But gold contributes to the headwinds that the Fed's facing, right, in terms of progress and getting us back to that 2% goal. It's a big part of electronics, aerospace. I was looking this morning, medical supplies, right, dentistry, space, computers, circuitry of computers. Basically, it feeds into ultimately those price components that we've seen and the pressures the consumer's feeling.
No, you're right. And when we take a look at just that very broad commodity index, the CRB index, it's 1% versus a year ago level. So to your point, we're seeing cocoa prices just explode. So that chocolate bunny is going to be a little more expensive this but those are part and parcel of everything that we're talking about. So some of it might still be supply chain. Some of it may still be just pure demand for product. Oil prices have picked up here a little bit, and it continues to be an issue. We've heard from the Biden administration they will add to the SPR when we get oil below 80. It's hanging above $80. So that may be a floor, at least, for demand on energy prices. But all of those things are contributing to what is termed as very sticky inflation. We think it's going to be here for a while, and it's something that right now, at least, the Fed is not really all that concerned about. I think they're more concerned about slowing or potentially slowing economic growth, which will allow them to cut interest rates.
You know, Paul, I'm looking at multiple products across the board. I'm curious your thoughts on copper. I know you keep an eye on these other metals as well. We're sitting here kind of, well, okay, we just recently got back up to 420, but kind of inching our way back up towards this 440 level. Take that out, we're back to levels we haven't seen since June of 2022, holding comfortably above the 50-day moving average here.
Yeah, and we've gotten some better news out of housing, and housing certainly is one of the
it's been strong, yeah.
Absolutely. So that's one of the things that, again, it's all playing into that economic growth factor. We're still seeing good economic growth. Atlanta Fed GDP now is still about 3.5–4%. Historically, a very high number. Normal long-term GDP growth is about 2–2.5%. So all of those things are pointing to still very robust economic growth, and we're seeing that robust, or at least sticky, inflation. So that's one of the reasons why when we listen to the commentary from the Fed and certainly Jay Powell, and we'll get more of that this week, it left a lot of people scratching their head. And I think the only decision many investors made was just buy.
Yeah, Powell, very clear that we are still in this data-dependent environment here. And, speaking of and along those lines here, I'm sure there's a lot of focus on China, right, as well as a contributor, or not necessarily as much recently, to that inflationary pressures that we're seeing worldwide here. I'm looking at some comments recently from the IMF managing director, that's Kristalina Georgieva. She was basically talking about China facing this fork in the road, right? She said China has two choices right now: return to its old economic policies or choose reforms to spur growth. According to the director, she said China's poised to face a fork in the road, rely on the policies that have worked in the past, or update its policies for a new era of high quality growth. I feel like Should we see expansion there? Should we see some real growth there? I mean, it would only kind of add to demand for these products, right? And in theory, kind of fuel prices higher. Looking at silver, another perfect example, an industrial metal that's kind of knocking on the door right around 26.
Yeah, I think when you take a look at China, I think actually China, along with Germany, is kind of the two basket cases, if you will, for the developed as well as the emerging market countries. China is struggling here, and they are faced with opposition from many of the other G7 countries. So they're kind of going alone here, and they've had some issues with how they've constructed their economy. Monetary policy is not working as well or as much as it has historically. So there may be some changes going on in China, and they may be going alone more than they have in the past. Part of the reason why we're reshoring a lot of the stuff, looking away from China. And again, that's just not the U.S. It's become a lot more globally, where many countries are looking to do more internally as opposed to globalization. So it could be an issue for China, could be a problem for overall economic growth, because that will hurt overall economic growth.
Paul, just to kind of wrap it up, bring it all together here and just kind of summarize our thoughts. I feel like commodities at elevated levels, right, but not necessarily to the point where it's raising concerns from the Fed, ultimately. I guess the question here is, where does the relief come into play? Does it come into play in terms of increased supplies? Because, right, with crude, that might be a little bit easier, not necessarily a flip of a switch, but easier than cocoa, for example. I'm hearing, as you mentioned, that could be years before we see some relief in terms of the supply side of things. Or does it come from diminishing demand? Because that's where the Fed, I feel like, has their finger on the trigger, ultimately, or on the button. Where do you see that relief coming into play?
I think really it's going to have to come from supply, because again, if we raise interest rates, does that necessarily stop or slow down a lot of that demand? And I look more to the service side for that answer. Manufacturing is fairly small as far as the overall economy. Services very large. Services continue to run pretty hot. We're seeing demand coming in from groceries, food, more than metals. Metals is certainly an issue. We're seeing demand for energy as people are moving about. But I think really the food inflation is one that really strikes to the consumer. If that were to continue, that could see much slower economic growth as the consumer starts to pull back. To this point, wage growth continues to be fairly strong. So again, that relationship is going to be important to hold to allow inflation to continue at current levels. If that breaks down, then I think the Fed is correct in their analysis.
Yeah, no indication the consumers pulled back yet at this point. Labor conditions remain very tight here in the U.S., so I think expectations are that's going to continue. If that's the case, look out gas prices, right? Because we're now, according to AAA, at $3.53 for the national average for a gallon of gas here in the U.S. That's up a dime from where we were this time last year, up 27 cents from a month ago. So, Paul, appreciate you joining us here. This is an ongoing discussion for sure. Paul Nolte, Senior Wealth Advisor, Market Strategist at Murphy Selvas Wealth Management.